Peter Lynch once said that the average person has an advantage over Wall Street. Think about that for a moment. In a world where billion-dollar hedge funds hire armies of analysts, how could an ordinary person possibly have the edge? It sounds impossible, yet Peter Lynch proved that sometimes the best investment ideas don't begin in a boardroom, they begin in your everyday life. And if you miss this lesson, you might spend years chasing complicated strategies when the simplest one has been right in front of you all along. Imagine you're standing in line at a busy coffee shop. The place is packed every morning. Your friends won't stop talking about a new restaurant. Your children are obsessed with a particular brand of sneakers. Everywhere you look, one company keeps showing up. Most people notice these things and move on. Peter Lynch noticed them and asked a different question. Could this be a great business? That simple habit became one of the foundations of his legendary investing success. Peter Lynch managed one of the greatest mutual funds in history, delivering remarkable long-term returns over more than a decade. But what made him extraordinary wasn't a secret formula or a crystal ball. It was his belief that ordinary people often discover winning companies before professional investors do. His famous advice, invest in what you know, wasn't an invitation to buy familiar stocks blindly. It was a reminder to pay attention to the world around you and then do your homework before investing a single dollar. Here's where many investors get it wrong. They hear exciting stories on television, scroll through social media, or jump into whatever stock is trending that week. Peter Lynch believed excitement was often the enemy of good investing. Instead of asking, what's everyone buying, he asked, what business is quietly getting better every year? That's a completely different mindset. Think about companies that consistently solve real problems. Maybe it's a retailer that's always busy, a software service businesses can't live without, or a healthcare company improving people's lives. Lynch looked beyond stock prices and focused on the business itself. Was it growing? Did it have loyal customers? Could it continue expanding for years? Those questions mattered far more than today's headlines. One of his greatest lessons is that patience often beats prediction. Many investors spend their energy trying to guess what the market will do next week or next month. Peter Lynch spent his energy understanding businesses that could thrive over the next decade. That's a powerful shift because markets are unpredictable, but great businesses often create value over long periods. Of course, invest in what you know doesn't mean investing without research. Loving a product doesn't automatically make its company a good investment. A business can have great products but too much debt, shrinking profits, or unrealistic valuations. Lynch always emphasized studying financial statements, understanding competition, and knowing why a company could continue growing. Curiosity came first, research came second. His philosophy feels even more relevant today. We're surrounded by endless financial news, viral investment tips, AI-generated predictions, and meme stocks that promise overnight riches. Information has never been more abundant, yet wisdom often feels scarce. Peter Lynch's approach cuts through the noise. Instead of following the crowd, observe the real world. Instead of chasing hype, understand businesses. Instead of reacting to every market swing, think like an owner. Perhaps the most overlooked part of Peter Lynch's strategy is that successful investing begins with observation, not speculation. The market will always be full of distractions, but opportunities often hide in plain sight, in the stores you visit, the products you recommend, and the businesses you trust. The next time you notice a company becoming part of everyday life, don't ask whether its stock will double tomorrow. Ask whether you've just discovered a business that could still be winning 10 years from now. That single question might be the difference between chasing the market and quietly beating it.